and welcome again. This is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is August 6th of 2021. It's our Friday Insights edition. Today we're going to go a little bit more in depth on an economic concept called stagflation. You know, recently we've all been experiencing over year the effects of inflation, whether it be transitory as the Federal Reserve talks about it, which ultimately just translates into temporary. Now, if you shop for an auto, both new and used lately, or even gone to the grocery store and had shrinkage in terms of on the packaging where they'll charge the same price, but it's less sort of ounces for you to take home. That's all forms of inflation. We're seeing it all around. Now, the Federal Reserve has had the ability to work on basically monetary policy 3.0, if you will, and their quantitative easing that they've been able to do, fiscal and monetary policy with the Congress over the last 18 months or so, by providing a backstop and support to replace the incomes. Remember, we just had a most recent jobs report. It was a positive number. It brought our jobs number or our unemployment rate down to 5.4%, which is the best that we've seen since the pandemic. But going back to March and April of 2020, we lost 22 million jobs in the United States. Now, we've got a ways to go. We're back about 16 million jobs from peak to where we are today. But that being said, that could put the Federal Reserve in sort of a catch-22 on a go-forward basis. Now, keep in mind, the Fed has a dual mandate, right? So they have full employment as well as keeping inflation at bay. Now, we all know that inflation is all around us. And the Federal Reserve Chairman Jerome Powell has said very specifically several times that their course is on track to basically go to full employment in the U.S. Now, keep in mind, full employment is another 2 percentage points down if you go back to February of 2020, when we had the best unemployment rate in probably 50 plus years of the U.S. economy. But more importantly, what the Federal Reserve is looking at all economic levels, right? So demographically speaking, it was a broad employment. Right now, that's not the case, right? A lot of people are out of work. And we have sort of government assistance ending in September, and those may never get their job back, right, because of replacement of technology or maybe different reasons out there, unfortunately. That being said, there's going to be the Federal Reserve's focusing on unemployment very exclusively. Now, the market is granting them the latitude right now in the interim, meaning they're going to give them the benefit of the doubt because the Fed has done what they say they can do, until they can't. Now, here's what's going to be interesting, right? Right now, here's the definition of inflation, what we're experiencing. Prices are increasing consistently, and purchasing power of money is declining, and goods are becoming more expensive, right? And as you know, if you have your money in the bank right now, the bank's not paying you anything. And as you know, the GDP, gross domestic product, just rose a year-over-year basis at just about 6.4, 6.5%. The 10-year Treasury, well, that's a story in itself, and I'll get to that in a minute. But the CPI, the CPI, both core and ex food and energy, both of them are running hot. Again, 5.4% year over year. These two numbers right now are what the Fed is ignoring because they're looking at the unemployment rate, okay? But the 10-year Treasury told us something this week. They just tested, again, a double bottom in the 10-year Treasury. We believe here at Blanke Schein Wealth Management, we're going to be seeing and following this along for our clients, that they went down. Now, we're going to finish the week at 1.3% on the 10-year Treasury as we film this broadcast today on Friday. But earlier in the week, we tested for the second time 12 basis points low on the 10-year Treasury twice. So that's called a double bottom. And if you follow technical trading, that's a very solid sort of, you hit a bottom and then you double test it. And we bounced significantly. Again, like I said, we are at 1.12% on the 10-year Treasury earlier in the week, and now we're at 1.3%. That just means, right, we saw financials and value stocks get a bounce. Again, that's why we have value in our portfolios, and we're fully diversified here at Blanke Schein Wealth Management in anticipation of this economic growth. So our clients are well positioned as they should be. But on the horizon, here's what we have. The Federal Reserve, as I said, has the latitude that the market believes the Fed can get what it wants. But if you know anything about history, going back to the 70s or even before, every recession or everything that really sort of, takes us off the line of what we thought it would be, very specifically it's called a recession here, is when the Fed can't get what it wants, right? So it's the Rolling Stones, but it can try. song, if you will. So it could try to get what it wants, but then something happens on the way. This could happen, which is stagflation. Now, stagflation, we had it back in the 70s, and it's when prices are unmanageable levels, as well as economic growth cannot contribute in any way to improve in the inflationary rates, right? So inflation ran hot, unemployment was hot, growth came down. We're not there yet, okay? But it's going to be something where we're going to see the 10-year Treasury is going to tell us that, as well as we expect these numbers to come down. That's realistic, but this could be stubbornly high for quite some time. So the Fed's going to have sort of a rock and a hard place decision, right, on the way to their guide path to monetary or policy and bringing down sort of the unemployment rate. They're going to have inflation and they're going to allow it to run hot. But for how long? And then how long is too long? We already see some dissension among the Fed in terms of now's the time. And ultimately, as we know, it's always too late when you start doing something, especially for the Federal Reserve. So it's going to be very interesting to pay attention to. We're going to watch it on an ongoing basis here at Blanke, Schein Wealth Management. But the 10-year Treasury right now is telling us a tremendous story. It is going to be the MVP to watch this year because it kind of has sort of a schizophrenic sort of trying to find its way through. And the Federal Reserve obviously is keeping track of that, but ultimately they are paying attention to the unemployment rate as we see it. So hopefully you learned a little bit today. Right now we're in the midst of it. This is really, again, on the edge of economic policy, on the edge of economic theory playing out. History is our guide. We can't really predict the future. Obviously, we can never do that. But at the same time, we can look to the past to help us see what rhymes and then take that from the playbook. But you can't always get what you want, but you can certainly try. And that's what we're going to see what the Federal Reserve is going to try to do, bring down the unemployment rate and have it go broader than it was even well before we started the pandemic. And in the meantime, keeping sort of hopefully the inflation rate at bay. Now, the one thing I didn't discuss, but the most important thing that we will look at, and through time, the reason why we never go from here to here is because of technology, right? It's because of my phone right here or the phone and the device that we have. Technology over the last 10 to 15 years has actually helped the Federal Reserve out to anytime they've been in a jam, they've had the ability to use and lean on technology because actually technology is deflationary and it sort of stops us on the way to stagflation. So that could be the one difference this time around that let's say the Volckers of the 1970s and early 80s and Milton Friedmans of the world, to go back to some greats, who took care of, stagflation back in the 70s. And they had to do it, the old-fashioned way, which is the stick. They had to really raise the real interest rates to 21.5% prime. And then we had bond markets sort of, and real estate markets and everything sort of levered to it accordingly. And then ultimately, just the only way you could do it is grow out of it slowly. And it was a painful approach until we have sort of new economic policies in the early 80s with Reaganomics. We see that playing out right now. We can see that playing out, not the stagflation part, but the on the way of inflation, which they're trying to do. Technology is going to save the day. Again, like I said before, I'm coming to you live from technology that wasn't even around basically 15 years ago, if you will, not even 10 years ago. So that could be the safety net that we have right now. And I think the Federal Reserve is thinking that too. So we'll see how this plays out. Thanks for watching us today. And again, like and subscribe and have a wonderful and safe weekend. We'll see you next time.